What is the primary purpose of life insurance? A. To provide investment income to the insured. B. To avoid paying taxes on income. C. To offer financial protection to beneficiaries upon the death of the insured. D. To reduce liability on loans. The correct answer is C. To offer financial protection to beneficiaries upon the death of the insured. Explanation. The core purpose of life insurance is to offer financial protection to the insured's dependents or beneficiaries in the event of death. This support helps cover expenses like debt, daily living costs, or future obligations such as education. Life insurance plays a critical role in financial planning, ensuring continuity of financial security after the insured's death. In life insurance, the concept of insurable interest means A. The insurer has the right to cancel the policy at any time. B. The policyholder must have financial or emotional loss if the insured dies. C. The insured must be government employee. D. The insured must pay higher premiums for riskier occupations. The correct answer is B. The policyholder must have a financial or emotional loss if the insured dies. Explanation. Insurable interest is a fundamental principle in life insurance. It ensures that the person buying the policy has a valid reason to insure the life of another individual. This interest must exist at the time of policy inception and typically involves close family or financial relationships to prevent wagering on lives. Which of the following best describes a renewable term life insurance policy? A. It cannot be extended after the initial term. B. Builds cash value over time. C. It can be extended at the end of the term without proving insurability. D. It requires a new health check every year. The correct answer is C. It can be extended at the end of the term without proving insurability. Explanation. Renewable term life insurance allows policyholders to renew the policy at the end of the term without medical underwriting. However, premiums may increase based on age. This feature ensures continued coverage for those whose health may have deteriorated. A major distinction between whole life insurance and term life insurance is A. Term insurance includes investment options. B. Whole life insurance provides lifelong coverage and builds cash value. C. Term insurance is more expensive due to the cash value component. D. Whole life coverage automatically ends at age 60. The correct answer is B. Whole life insurance provides lifelong coverage and builds cash value. Explanation. Whole life insurance offers permanent coverage and includes a savings component that builds cash value over time. In contrast, term insurance only covers a specific period and has no savings or investment component. An endowment life insurance policy pays out when A. The insured dies within the policy term only. B. The insured reaches a specified age or dies during the term. C. The insured gets married or retires. D. The policy is surrendered after 3 years. The correct answer is B. The insured reaches a specified age or dies during the term. Explanation. Endowment policies are designed to pay a lump sum either on a specific maturity date when the insured survives to a set age or upon earlier death. These policies combine savings with protection and are often used for education or retirement planning. Which of the following is typically not a feature of universal life insurance? A. Flexible premium payments. B. Ability to adjust death benefits. C. Investment in a guaranteed government bond. D. Accumulation of cash value. The correct answer is C. Investment in a guaranteed government bond. Explanation. Universal life insurance offers flexibility in premiums and death benefits and includes a cash value component. However, it does not guarantee investment in government bonds. Instead, it often offers a fixed interest rate or market-linked investment options. Group life insurance is typically A. Purchased individually by policyholders from an agent. B. More expensive due to customization. C. Provided by employers and covers multiple individuals under one contract. D. Only offered to people over age 60. The correct answer is C. Provided by employers and covers multiple individuals under one contract. Explanation. Group life insurance is a policy that covers a group of people, and often employees of company, under single contract. It is generally cheaper per person, with simplified underwriting, making it more accessible to a broader group. A critical illness rider in a life insurance policy provides A. Death benefit in case of accidental death only. B. Additional cover for the insured's children. C. Lump sum payment upon diagnosis of specified illness. D. Monthly payments to cover job loss. The correct answer is C, a lump sum payment upon diagnosis of a specified illness explanation. A critical illness rider offers a lump sum payout if the insured is diagnosed with a covered serious illness such as cancer, stroke, or heart disease. This rider helps cover medical costs or compensate for lost income during recovery. What is meant by the surrender value of a life insurance policy? A. The amount the beneficiary receives at death. B. The cost of cancelling a policy before maturity. C. The policy's accumulated value payable upon voluntary termination. D. The premium required to reinstate lapsed policy. The correct answer is C. The policy's accumulated value payable upon voluntary termination. Explanation. Surrender value is the amount an insurer pays to the policyholder if they decide to terminate permanent life insurance policy early. It represents the cash value that has accumulated minus any surrender charges or outstanding loans. Which of the following is a living benefit of a life insurance policy? A. The death benefit paid to beneficiaries. B. The payout to the insurer. C. The cash value or critical illness payout received by the insured while alive. D. The taxes paid on investment earnings. The correct answer is C. The cash value or critical illness payout received by the insured while alive. Explanation. Living benefits refer to features of a policy that allow the policyholder to access funds while still alive. These may include withdrawals from cash value, policy loans, or accelerated death benefits for terminal or critical illness. Which of the following is most likely to result in a higher life insurance premium during the underwriting process? A. Preferred risk classification. B. A healthy lifestyle and regular exercise. C. Working as a deep sea fisherman. D. No family history of chronic illness. The correct answer is C. Working as a deep sea fisherman. Explanation. Occupation is a key factor in underwriting. High-risk occupations such as deep sea fishing expose individuals to greater physical danger, which increases the insurer's risk and results in higher premiums. In contrast, preferred risk classification or healthy lifestyle typically lowers the premium. What does a substandard risk classification indicate in life insurance underwriting? A. The applicant has a higher than average life expectancy. B. The applicant is eligible for preferred premiums. C. The applicant poses a higher risk to the insurer due to health or lifestyle factors. D. The policy is automatically denied. The correct answer is C. The applicant poses a higher risk to the insurer due to health or lifestyle factors. Explanation. A substandard classification means the individual presents a higher risk due to factors like poor health, dangerous occupation, or risky hobbies. These applicants may still obtain coverage, but often at higher premiums or with policy exclusions. What distinguishes medical underwriting from non-medical underwriting in life insurance? A. Medical underwriting does not require any health disclosure. B. Non-medical underwriting always leads to higher premiums. C. Medical underwriting requires health exams and detailed medical history. D. Non-medical underwriting is only for preferred applicants. The correct answer is C. Medical underwriting requires health exams and detailed medical history. Explanation. Medical underwriting involves a thorough assessment including medical exams, lab tests, and a review of health history. Non-medical underwriting may rely only on questionnaires and does not require physical tests, often used for smaller policies. Which statement best describes an irrevocable beneficiary in a life insurance policy? A. The policyholder can change the beneficiary at any time. B. The beneficiary must be informed before any policy changes are made. C. The beneficiary has no legal rights until the policyholder's death. D. The policyholder needs the beneficiary's consent to change the designation. The correct answer is D. The policyholder needs the beneficiary's consent to change the designation. Explanation. An irrevocable beneficiary designation means the policyholder cannot change the beneficiary or make changes that affect the beneficiary's rights without their consent. This provides legal assurance to the beneficiary. Which of the following is a right typically held by a life insurance policy owner? A. Adjusting the mortality tables used in premium calculation. B. Determining the risk classification of the insured. C. Assigning or transferring ownership of the policy. D. Changing the underwriting process. The correct answer is C. Assigning or transferring ownership of the policy. Explanation. Policyholders, owners have legal rights such as changing beneficiaries if revocable, assigning the policy, or borrowing against it if cash value exists. Underwriting and risk classification are managed by the insurer. Which of the following premium structures generally increases with the age of the policyholder? A. Level premium. B. Step premium. C. Annual dividend premium. D. Fixed index premium. The correct answer is B. Step premium. Explanation. Step premiums increase as the policyholder gets older, reflecting the increased risk of death with age. They are typically cheaper initially but become more expensive over time. Level premiums remain the same throughout the policy term. How does paying life insurance premiums on a monthly basis typically impact the total cost of the policy compared to annual payments? A. It significantly lowers the total cost. B. It has no effect on the total cost. C. It usually increases the total cost slightly due to administrative fees. D. It causes the policy to lapse sooner. The correct answer is C. It usually increases the total cost slightly due to administrative fees. Explanation. Monthly or more frequent premium payments often incur extra charges to cover administrative handling, making the total cost over a year higher than a single annual payment. In estate planning, why might someone choose an irrevocable beneficiary designation? A. It allows for easier policy cancellation. B. It ensures the proceeds are distributed outside of the estate. C. It gives the policyholder full control over the policy. D. It enables automatic conversion to annuity. The correct answer is B. It ensures the proceeds are distributed outside of the estate. Explanation. An irrevocable beneficiary designation can help avoid estate taxes and probate delays by ensuring that proceeds go directly to the beneficiary, supporting efficient estate planning. Which of the following factors is most likely to reduce a policyholder's life insurance premium? A. Advanced age. B. Smoking history. C. Standard risk classification. D. Excellent health and no risky hobbies. The correct answer is D. Excellent health and no risky hobbies. Explanation. Underwriting heavily rewards applicants with excellent health and low-risk lifestyles with preferred or lower-risk classifications, resulting in lower premiums. Age and smoking increase risk and cost. What is the primary difference between preferred and standard risk classifications? A. Preferred applicants must pay extra fees. B. Preferred applicants own better than average health and lifestyle. C. Standard applicants are denied coverage. D. Standard risk classification results in policy exclusions. The correct answer is B. Preferred applicants own better than average health and lifestyle. Explanation. Preferred risk applicants demonstrate superior health, no risky behaviors, and often receive lower premiums. Standard risk applicants are considered average in terms of health and behavior, receiving regular premium rates. In New Zealand, life insurance death benefits paid to beneficiaries are generally A. Subject to income tax. B. Exempt from estate duty but taxed on distribution. C. Tax-free to the beneficiary. D. Taxed only if the policy was held in a trust. The correct answer is C. Tax-free to the beneficiary. Explanation. In New Zealand, the death benefit from a life insurance policy is generally paid tax-free to the named beneficiary. It is not considered income, and there is no estate or inheritance tax applicable. This favorable tax treatment supports life insurance's role in estate and financial planning. Which regulatory body oversees conduct and licensing requirements of financial advisors in New Zealand? A. Reserve Bank of New Zealand RBNZ. B. Inland Revenue Department UD. C. Financial Markets Authority FMA. D. Office of the Ombudsman. The correct answer is C. Financial Markets Authority FMA. Explanation. The FMA, Financial Markets Authority, is the key regulator of financial services in New Zealand. It monitors financial advisors, enforces licensing under the Financial Services Legislation Amendment Act (FSLA), and ensures market integrity and consumer protection. Under the Financial Services Legislation Amendment Act (FSLA), financial advisors must provide disclosure to clients. A. Only if the client asks for it. B. At the time of the claim being submitted. C. Only for investment products. D. At key points during the financial advice process. The correct answer is D. At key points during the financial advice process. Explanation. The FSLA requires financial advisors to provide clear and timely disclosure about their services, remuneration, and conflicts of interest. This must occur at key points, such as before giving advice or when the nature of advice changes. It ensures clients can make informed decisions. If a policyholder makes a withdrawal from a life insurance investment-linked policy in New Zealand, The tax implication is A. The entire withdrawal is exempt from tax. B. Tax is applied to the capital component only. C. The investment gain portion may be taxable. D. All policy withdrawals are taxed at marginal rates. The correct answer is C. The investment gain portion may be taxable. Explanation: withdrawals from investment-linked life insurance policies in NZ may trigger tax on the investment return portion of the withdrawal, not the original capital. The tax treatment depends on whether the policy qualifies under portfolio investment entity, PI rules, or other structures. Which of the following best describes the contestability period in a life insurance policy? A. A waiting period before claims are processed. B. A period during which the insurer can challenge the validity of a claim. C. The time during which the beneficiary can contest the policy terms. D. A period when the premium can be renegotiated. The correct answer is B. A period during which the insurer can challenge the validity of a claim. Explanation: the contestability period is typically the first 2 years after a life insurance policy is issued. During this time, the insurer can investigate and potentially deny claims based on non-disclosure or misrepresentation. After this period, policies are generally considered incontestable except for fraud. When recommending a replacement life insurance policy, advisors must ensure A. that the new policy has a higher premium. B. that the client is aware of churning risks and suitability. C. that the insurer offers a discount for switching. D. that the old policy is cancelled immediately. The correct answer is B. that the client is aware of churning risks and suitability. Explanation: when recommending replacement life policies, advisors must assess suitability, avoid churning, unnecessary policy replacement for commission, and inform clients of potential disadvantages such as new exclusion periods or loss of benefits. What is the role of a claims assessor in the life insurance claims process? A. To manage client budgeting. B. To underwrite the policy. C. To evaluate the validity of the claim. D. To sell additional insurance to beneficiaries. The correct answer is C. To evaluate the validity of the claim. Explanation: the claims assessor reviews the claim and documentation to determine whether it meets the policy's terms. They assess details such as cause of death, documentation, validity, and any contestable issues. Their role is critical to ensuring claims are paid fairly and efficiently. Under New Zealand law, what standard must a financial advisor meet when identifying vulnerable clients? A. Ignore vulnerability unless the client discloses it. B. Offer standard advice regardless of conditions. C. Provide advice that considers capacity and comprehension. D. Decline to advise all vulnerable individuals. The correct answer is C. Provide advice that considers capacity and comprehension. Explanation: advisors must follow the Code of Professional Conduct, which requires them to identify and accommodate vulnerable clients. This includes considering a client's mental capacity, financial literacy, and emotional state to ensure advice is appropriate, ethical, and client-first. When is a death certificate typically required in the life insurance claim process? A. Only if the policyholder dies abroad. B. After the claim is paid. C. As one of the first documents submitted. D. Only if the beneficiary is a minor. The correct answer is C. As one of the first documents submitted. Explanation: a certified copy of the death certificate is one of the first documents required when lodging a life insurance claim. It provides formal verification of the insured's death and is essential for assessing the validity of the claim. The client-first principle in the Code of Professional Conduct requires financial advisors to A. Focus on sales targets. B. Act in the best interest of their employer. C. Prioritize the needs and interests of the client above all else. D. Avoid giving advice without charging fees. The correct answer is C. Prioritize the needs and interests of the client above all else. Explanation: the client-first principle mandates that advisors place the client's interests, goals, and well-being ahead of their own or their firm's. It underpins ethical financial advice and is core standard under the Code of Professional Conduct for NZ financial advisors.